Jen with the Berbas Group in Austin, Texas, coming to you with the real estate numbers from March of 2024. We are going to jump right in and start talking about some of the data that's in our newsletter. So we're starting to see prices creeping up in March timeframe, kind of what we would expect for normal seasonality. Things are pretty slow over the holidays, and they are creeping up a little bit right now. Then we're also starting to see the pending numbers come up in March. Again, what we would expect if you looked at last year, it's pretty predictable. We are super excited about this chart. We've been collecting this data internally because we don't think that MLS gives you a way to go back and generate this retroactively. So we've been collecting this week by week. A lot of really good information here. The very top line is the active properties. The next line is the properties that are pending. What we did is we took a 12 miles from downtown area so that we're always looking at exactly the same parameters, right? And so this is pending properties that are marked pending within this data set at this time. The next line is properties that have been marked within this parameter in the last 7 days. So the last 7 days gives you a little bit more granular view. And then below the very bottom is the closed properties. Couple interesting things from this chart. What you'll notice is that a lot of properties were taken off the market right here in December. We would expect that. Sellers know there's not going to be a lot of activity over the holidays, so they pull their houses off the market, whether it's their primary residence or their investment properties, to reset the days on market and look like a new listing when they come back on. And you can see here then there's a commensurate big increase in inventory about 90 days later, just like you would expect, right, from this year. We weren't sure that was going to happen, but we thought it might. And so a lot of them did, in fact, come back onto the market. We don't know, of course, if they're the same properties or not, but it was a little bit of an increase in inventory that we thought might happen. There is a 30% increase in inventory in the last, I think, 3 to 4 weeks when we looked at these numbers earlier today, and only a 5% increase in the pendings. So we are starting to see this widen a little bit. We're reviewing these numbers with our sellers before they go to market because we think it's really important for people that actually want to sell this year to price in front of the market, right? Not to sit there and follow the market down, but to anticipate where the market's going to be and let the market catch up with them. So we've been discussing that with our sellers and reviewing this data with them. And what's driving a lot of this? Well, a lot of the inventory right now is being driven by interest rates. Interest rates are off their highs of 8%. What I think is important for consumers to realize is there is a relationship between interest rates and pricing. If all other variables stayed the same and interest rates came down 1%, we would expect pricing to go up 10%. Okay, and that's if demand stayed constant. But in all market systems, there's a lot of variables, they all move around. But if interest rates went down like another percent from here to the low sixes, we would expect pricing to go up about 10%. Again, it's not a fixed system, it's not a closed system, there's a lot of variables, so it's a little bit more complicated than that. But we do have interest rates in the low sevens, a little bit better than the low eights or high sevens that we had before. And this next chart gives us a little bit of a view into the future potentially, or at least what the Fed governors think the future might hold. Each dot here represents a vote by the Fed governors on where they think interest rates might be in the future. So this year, this first column is 2024, this next column is 2025, and then here's 2026. So each dot, it gets a little bit more dispersed as you go on in time because the certainty goes down. But there is an expectation by the Fed that by 2026, Fed rate, the overnight rate, would be 3%. Now, it's important to remember that this does not mean mortgage rates would be at 3%. Mortgage rates are usually above this by, I think, 175 basis points. So that means that mortgage rates would be at like 4 3/4, something like that. Go ahead and give us a call if you have any questions. We love talking about this stuff. We're here for you to talk about the market or anything else real estate related that you need.